Last Friday's government employment report showing an addition of nearly 950,000 jobs in July. That included more than 250,000 in the food, services, and drinking places category. But big struggles remain for restaurants, which are scrambling to find workers and pay them attractive enough wages. Joining us now to talk about the industry's challenges, Richard Allison, Domino's CEO. Rich, great to have you with us. Good morning.
Thanks. It's good to be with you.
How difficult has it been for you to find workers?
It's been the toughest staffing environment, that we've seen in a long time, over the course of, the late spring and into the summer. We're starting to see some pickup again in application flow coming through, but it's been a tough staffing environment, Melissa.
Domino's has always been on the forefront in terms of employing technology and finding efficiencies there. Are there ways to further increase your technology to offset some of the pressures from this tight job market?
We're working on a couple of things. First, as it relates to the jobs themselves, in our corporate store business, we've done a significant amount of wage increases over the course of this year, and we've got more to come. We've also been looking at the jobs themselves and really trying to take, out through technology and through some changes to our operating procedures to take out some of the things, that team members don't enjoy doing and keep them focused on, in the example of drivers, delivering pizzas to customers, which is where they make the most money. And then technology is also helping us as we think about how we forecast, how we schedule, how we staff, how we route deliveries. So many other aspects of the business to try to get more efficient with the workforce that we do have.
So wages sound like they have gone up. They may continue to go higher depending on what the market bears. I don't know about what your food costs, your input costs are. At the same time, you've got the opposite impact in terms of technology, increasing your efficiencies. How are margins? How do you think about margins going forward in this sort of environment?
So, I talked about this a little bit a couple of weeks ago when we released our earnings. Our margins in our corporate store business were actually higher than we'd like to see them in the second quarter. And a lot of that was driven by the fact that we were understaffed in many of our stores. So I do expect us to see, some margin compression there as we get back up to staffing levels. And most certainly labor costs have risen this year and are going to continue to rise. As far as the food costs go, we've got a fantastic team that manages our commodity purchasing. We run our own supply chain, in the U.S. business for Domino's. And so we've not seen significant increases in input costs with the exception of a few proteins this year. Now looking into next year, obviously that could change as, we're seeing some increases in things like corn and soy and wheat. But it is, it's always in the restaurant industry, Melissa, it's always a battle. Costs are always rising in terms of food and labor, and we're always driving operational efficiencies and innovation to help offset that.
So consumers are going to have to pay more for things like toilet paper and rotisserie chickens at Costco. They're not going to pay more for a pepperoni pizza at Domino's, Rich?
Well, we stay focused constantly on value and making sure that the all-in cost of having your food delivered to you from Domino's is as competitive as anything out there. Now, we'll have to take a look at pricing, and we do that every year to see, where we may need to move up in some places based on, some of the cost inputs in the business. But we've been able to hold very consistently. In fact, our $5.99 mix and match delivery offer has been in place for more than 10 years now.